welcome to the close. We have 10 minutes left until trading wraps up. And helping us to break down today's action, we've got Zara Burton. She's down in the newsroom. Trader Dan Deming of Stutland Equities standing by the Chicago Board Options Exchange. And our featured guest is Joe Saluzzi, the co-head of equity trading at Themis Trading. And Joe, we're going to start with you. Are you starting to feel vindicated? We're down 4 days in a row here.
We've got a long way to go.
Okay.
This is just the beginning of a downtrend.
Really?
Yeah. This is it
now, you think?
I have noticed a change in market character. I'm not going to say that we're not going to go back up again because the dip buyers do get excited when they see the printing press of the government start. So my biggest concern as a bear right now, if the Fed stops the printing, and two things I'm looking for is obviously the quantitative easing, see if they want to increase that later, or more importantly, this homebuyer credit. This is very important now. If they were to extend that 8,000 to 15,000, which was the original proposal, which is probably not going to happen, right. If it just does a phase out, that happened on Monday. When the news story broke on Monday about this being just a phase-out, the market reversed.
Extended but reduced.
That's right. And they'll reduce it for 6 months. I think it would phase out within 6 months. The market reversed 200 points. That tells you that everybody is addicted to the stimulus, and they know that without the government printing press, this economy has nothing to stand on.
Let me ask, I mean, that's interesting because then even the slightest bit of reduction in quantitative easing gets people freaked out.
Yep.
What about, and these are headline stories, right? But there are whispers that the Fed came in and supported the market at the beginning of March, at the end of February. And we had Mark Faber on the show talking about the Bernanke put, saying when we get to 900, the Fed is going to get active again. Do you buy that?
Well, hey, there's all sorts of conspiracy theories, and I'm obviously a conspiracist, right? I follow a lot of those. But, yeah, the PPT, right, the plunge protection team, I don't know what those guys are doing. All that matters to me at this point is the dollar, and when the dollar is starting to rise, that's telling you that maybe they're finally going to stop printing money. Maybe they're going to show some fiscal responsibility here and see if this economy really has anything. But I got a problem here because yesterday's consumer confidence number was a disaster. It was a total annihilation, and the biggest problem that I looked at inside those numbers. 50% of the people surveyed said that it was very hard to find a job versus 37% a year ago. That number is up tremendously, and that tells me, remember we always talk about unemployment being a lagging indicator. Unemployment is not a lagging indicator because what's happening now is people are afraid for their jobs. They can't find jobs now, and they're waiting on unemployment from the government, but now they're not going to spend.
But things are getting somewhat better. You are starting to see, I see you there, I see that look in your eyes, but I mean, we are seeing companies starting to maybe slowly hire. We've heard from, was it Google, who said that they're going to start adding workers? I mean,
well, that's great.
You know, go back a few months ago, nobody was talking about this.
And we're seeing the temporary work picture turn around, which we're going to talk to an economist later who says that's a leading indicator for the non-farm payrolls.
I would say that temporary work is exactly that, temporary. No one wants to hire. These companies found out that they can do the job with less employees. They fired everybody last year, right? That's how they made their earnings numbers. And then they realized, hey, we can do the job without them.
But
why would they hire them back?
But demand's going to start increasing.
Will it? I mean, based on the numbers in yesterday's consumer confidence numbers, they are not even spending. When they asked about a new car, only 1.4% are going to buy a new car. Why? Because they already bought it in cash for clunkers, right? There is nobody. The spending is the main concern. 70% of the economy is consumer driven. If these people are not confident, which they're not, the disconnect between Main Street and Wall Street exists.
I was at a department store. It was packed.
Where? New York City, right?
Sounds like Harrison. All right, hold on a second. Let me look at stocks here. Joe is not fighting the tape today. Let's see where stocks stand.
You know, I think, you know, the underbelly of this market has been exposed, and that is buyers aren't real. The buyers, the last 6 months, I'm going to call it a bull trap. Just like a bear trap is out there, right? This was a bull trap. These are not real buyers, okay? This was price chasing. All that's what was going on right now. So right now, it's hard for people to change their mentality. They want to believe. So they'll never switch because they believe they're right until it starts to really turn around, and that could be 10% lower from now.
Go ahead, Matt. No, you go ahead.
I'm wondering, you know, Lincoln Ellis one time came on here and said, there are hedge funds that are prepared to go really short when they see a few down days in a row. When the dip buyers lose confidence and they realize, okay, now we can really go in here and short this market. Yeah. Do you see that? Do you hear that here?
I believe that. I do think still the wild card is the government. You cannot fight the government. You cannot fight the Fed. That axiom is so correct. If they were to come in and pull one of these other, you know, stimulus programs and decide they want to spend some more money, it'll just totally cut the legs out from any sort of short move like that. So people are still cautious. Myself, you know, I'm building my shorts. I'm telling you right now, I am feeling much more comfortable shorting stocks here. However, I'm still cautious. I don't want to go all in at this point.
But you've been cautious since the beginning of the year. I mean, you talked with us back in January, and you were looking for, I think, something like the S&P falling to the mid-600s by the end.
We got that in March.
But you said
I got that 660, didn't I not? I was just a little bit early.
All right, but we're well above it now at this point.
Well, what happened was I didn't change my philosophy, right? I was still too bearish, saying it's going to go lower and go, and but I got the mark. I was just 2 months. I didn't think it would happen in 2 months.
All right, we'll talk more about that. We got to talk though about the closing bell sounding on.
Mentioned they had a 2% transaction tax enacted a couple of weeks ago. That killed the speculators in Brazil. Just destroyed them. So that tells me that Brazil is obviously a speculative stock market. What would happen if, God forbid, a transaction tax was enacted into the United States stock market? Do you know where the speculators would go? They would say, see you later, because they can't trade that way. So I am still...
You're not suggesting this administration would consider raising taxes or even creating new ones?
Maybe to pay for some of the bailouts? But you know what? It is a concern, and maybe some of the U.S. people are starting to look at that, because it has been a talk around Wall Street about this transaction tax. It would drive the speculators out and would prove, obviously, my point that speculators are driving this market. It's being proven right now in Brazil. Okay, and I agree with Dan, by the way, these 50-day moving averages are critical right now. I watched the financials and the transports break a few days ago, and those were the signs to me that this is starting to break down here. And everybody watches technicals now because the fundamentals don't matter.
Let me ask you, though, because you were just saying how important the consumer is, and that's what you're focusing on. And if you get away from the technicals and how many buyers on the sidelines and this whole casino mentality here and really look at what's important, right, the economy.
Yes.
What is different this time for the consumer about this recovery from the recession? I mean, we always see unemployment lagging the recovery, right? We saw 10% and higher unemployment in the 81-82 recession. What's different this time that makes people say the sky really is going to fall
now? But you know in your heart there's a difference in the economy and Wall Street and the stock market. People have to stop thinking about the stock market because it is a casino, like you just said. And price over there doesn't equal value. The real economy is what the consumer is saying, and that's what was in that consumer confidence report yesterday, and that's telling us there's lots of problems still, and that the government hasn't fixed it. The government short-term fix of pumping money is not a long-term plan. What is their plan? They can't just pump money.
But this is how they recover. This is how the Keynesian government recovers from recessions, and it worked every other time.
No one's saying that this is what you do and this is what you stay with forever, Joe. You know they had to fix the financial mess that happened, hit ahead last fall.
What's wrong with letting companies fail?
I don't disagree with you, but we've done this course.
Let's take a look at GMAC today. Why is the government bailing out GMAC? I got a note from my buddy Frank Sorrentino, who runs New Jersey Community Bank. The government,
by the way, the stress test.
Of course, because it's a real bank that lends to people and looks at quality of lending.
Right.
But the government is subsidizing GMAC at the expense of the community banks now, because Ally Bank, which is GMAC, is offering more competitive rates than a regular bank could. How could a community bank compete now with a government-subsidized entity? And who's paying for that? We are.
Right.
We are, the taxpayer.
Let me ask you, Dan, let me bring you back in here.
Sure.
I mean, what is the difference this time is that the current economy is not based on industrial production, which provides blue-collar jobs. And then another viewer asks Joe here in the studio to talk to the jobless recovery. I mean, we have seen a couple of recoveries, most notably from the internet bubble, where there was a jobless recovery, and we weren't based on industrial production at that time either, right? I mean, isn't it the same thing?
Well, like Dan, I'm not an economist. We can't predict this. But what we do know is that when there are no jobs, people don't spend money. I mean, it's a very simple strategy here. You need to create jobs, and we don't have any. This is not the bottom in the job market. We've got lower to go, and that's the real problem. If you could tell me that, hey, we're getting more confidence, we're going to build jobs, there's some great programs out there. We're not. It's just the opposite. But if you want to talk to this, we brought a chart.
But it is better than it was a year ago or 8 months ago.
No, you're being fooled by the government. You're being fooled by the pundits who are telling you it's better. It is not better. The numbers are there. I point to this. I brought a chart. I hope you can bring it up.
Can we bring up Joe's chart here?
This was the telltale sign for us. Money is flooding out of equities in the domestic equity mutual funds. It's from the ICI. Our friends over at Zero Hedge put together a chart which shows you how the spiders and the domestic equities are diverging. That tells me the price action is moving too high and is not reflective of the real fundamentals of real investors, not price-seeking crazy men who are just driving it up all day.
They're so bullish at Zero Hedge.
Right. Look, Zero Hedge, by the way, is a fantastic blog. Some people give him
we've done the story
he tells you the truth. Okay?
That all
That's
the
what
money's
people
flowing
need.
into bond funds. We've done that story. We know that. We've certainly talked about
which
that
is a
lot.
bad move also. Why are you going to buy a long-dated bond? Maybe a short-dated bond, but you don't want to get anything long right now.
Everybody's shorting the long-dated bonds. Is that the play of the century here?
Who knows?
All right, so
let's go back. Let's go back. What the market can be, and we'll see where it goes from there. Go ahead.
We got to run. Dan Deming, Joe Saluzzi, thank you so much.
And Zero Hedge. We're back in two.
Stick around.